Matt, this brings me to the CBRE piece, which I really like the idea of. This is in their chart of the week. It's from just a couple days ago. I am clamoring for more details.
We have contacted the author.
Okay, good. Okay. We've reached out to Mike Leahy, who we've covered a handful of his pieces. It's got a good mustache, and so we know we can do some good work. But a really great graph, but there's all these blank boxes I want to know. Yeah. So anyway, this piece is, it reminded me of that Berkadia article we touched on like 2 or 3 years ago, but it's talking about portfolio construction related to multifamily investment, which big passion of mine, looking at not just investing in an asset, but building a diversified portfolio of cash flow and multifamily real estate. Get so excited about talking about this. And they're talking about diversification and pairing different markets that are correlated or uncorrelated to the broader multifamily market or just broader market in general.
Yeah.
And talks about a lot of statistics, to go into of markets that, are correlated or uncorrelated to each other and what those return profiles of those different paired markets could be, but really doesn't give too many examples other than markets that kind of fall outside of that are kind of outliers and that don't show as much of a correlation or non-correlation. And so Mike, we'd love to have you on to talk about this, or just to see more of the data. So we'd love to dig in and do some comparisons on different markets, not just different markets, but different asset classes. Yeah. So like, Washington, D.C. apartments with maybe paired with a Houston apartment investment. Yeah. That blended risk and return profile is just a really interesting concept and something that investors should think about when they're making allocations, not only looking at the deal, and the deal is really important, just like the sponsor is incredibly important. Like the deal's got to make sense. You can't just be like, I need to find an industrial deal in Los Angeles somewhere. Yeah. It's got to be the right deal, but that right industrial investment in Los Angeles with the right apartment investment in Houston or Indianapolis could have a really interesting risk and return profile that protects from the downside, but also allows you to take advantage of some potential upside. Yeah. And go ahead.
And no, it's funny because that's what I was kind of thinking of, like these examples of markets that, the apartments in one and the industry in the other. But I was also thinking, like, on the counterexample, there could be markets that are maybe dangerously correlated for whatever reason. Like, what if you get the apartments in one city and then the close by you get the industrial in another city, but like when one tanks, the other does because all of the people that worked at the factory, live in the other one. Like that's a very basic.
Well, that's what you want to be. That's what you want to look out for. Is you don't want to be in an overly concentrated position, and whether it's geographic concentration, asset class concentration, or as people have learned recently, sponsor concentration. Yeah. There have been just some sponsors that did just a lot of bad deals in different markets, and you could invest with that sponsor and been sort of geographically diversified. I'm thinking of a couple different kind of high-profile sponsors. Yeah.
But if there's
articles,
correlated,
Tides Equities, GVA, that were heavily invested in the Sun Belt or kind of like Tennessee, Southeast. Yeah. Diversified across different markets, but they ended up having to hand a lot of those properties back to the bank or the lender because it ended up not working out.
Well, because I would argue that some of these apartment markets, like I sometimes would lump in, this was early in the pandemic, the Sunbelt markets with like Boise or Salt Lake City, or like places where you want to go and hang out, or like attractions. Yeah. And they had the same rough pattern of apartment supply and like huge demand and then the falling off demand. So there are interesting ways and interesting intersections. And, I'm also thinking, well, if you're talking about like maybe commercial or office space, maybe San Francisco is correlated with like San Jose or something as like tech capitals. And
yeah, exactly. Industry overlap. But also just again that risk profile of like the ability to take some higher risk investments, but you're pairing those with some lower risk, more stable allocations as well. Yeah. And so you're protecting from the downside a total loss on the risk or investment might not mean a total loss of your overall CRE portfolio. It may mean an underperformance, and you're getting a 12% total return rather than 15 or 20. But if that risk or investment hits, you are potentially able to significantly outperform the market, but more of your stable investments, acting as a balance to the overall portfolio. I think it's a good exercise to think about, again, not just I'm investing in multifamily and in this market with this sponsor, but thinking about, all right, I'm going to make allocations to build like the right risk and return profile for my goals and objectives. And again, maybe that California or New York or California, last mile industrial paired with suburban, Indianapolis multifamily is really exciting, or even some Midwestern multifamily logistics with maybe even like in Austin, Texas. Like I'm gonna take a flyer because Austin, I think the values might be really down in the dumps in Austin. But I think there's going to be a lot of growth and cap rate compression. So I'm going to take a flyer on Austin, but then I'm going to do some stable investments elsewhere and see how it all works out. Or you go all stable and you're just okay with maybe a lower return profile, or you go all high risk and just roll the dice.
And keeping this in mind, and
non-investment advice, by the way.
Well, and I'm thinking that the points here, the underlying thesis is diversification. Yeah, that's that it's always true. It's kind of evergreen, but I think it's in uncertain times when risk is it's not just a intangible thing. It's like you could see things going wrong or potentially going wrong everywhere, that you better know the nuts and bolts and the knobs to twiddle to get the right amount of risk that you're comfortable with.
Yep. It's all about finding the pursuit of the efficient frontier. Getting a really strong Sharpe ratio, and that's all how it fits into your broader portfolio of stocks and bonds and other stuff. So it's a good thought exercise, a way to think about things, but also just the pursuit of trying to quantify. Sometimes in real estate in the past, it's been sometimes harder to quantify these things because sometimes there's not the data. We don't always have good cap rate data or transaction history. That's getting better over time. But being able to put some actual numbers, and this is where I'd love to get the actual data from this report, and so we could actually look at some of their analysis on those pairings. Or maybe we're just going to have to do some of it ourselves, Matt.
I know, and it's not impossible. Maybe we will.
Nothing is impossible.
Oh, not at all. We are in contact with Mike Leahy, so I shot him an email, and we'll see what he says.
Has he gone back to us?
Not yet. I want to. I have contacted him. I'm not in contact yet.
And it was like an hour and a half ago, so it's okay. We'll give him a grace period.
Yeah, that's right.
But no, it's a great report, very thought provoking. And again, I just like to dive into the details.
Yeah, totally.
Because it's really interesting.